All right, welcome everyone. We are here in a new country, and today we're going to talk about taxes and investing and how you want to correspond the types of investing you're doing to the types of taxes that you're exposed to, and what that means in terms of what the best opportunities can be for someone in a given place. However, before we talk about that, we're going to play the game of Where is Michael? And so I'm going to show you, I am at one of the more recognizable places in this country because this is not a very recognizable country. So you can kind of see here, you can see some steps, you can see some fountains, you can see a lake. Yeah, and so we will now kind of go for a walk. You guys should guess, find out where it is that you think I am, put it in the comments below, and then we'll find out on the next video whether you were correct or not. So let's dive in and talk about that. Before we do that, however, let's just get into some of the background on why I think this is, especially interesting and important. So the thing is, when we're investing, what is the objective, right? The objective is not necessarily to make pure returns. It is to have the most money in our pocket at the end of the day. Okay, great, wonderful. So, well, what does that mean? That means we have to inherently consider the after-tax, after-fees returns, right? And the thing is that the types of income that you have could be taxed totally differently depending on where you are in the world and what your situation is. So, for example, you will hear a bias from a bunch of wealth advisors, say coming out of someplace like Canada, saying, listen, we want capital gains tax income as opposed to, say, interest income. And provided you're not in some sort of a tax sheltered vehicle like an RSP or a TFSA, or if we're talking about someplace like the US, we're talking about, a 401k or a Roth IRA or et cetera, and various different parts of the world have their own kind of version of this. Unless you're in that situation, this is generally going to hold true. Now, obviously you can parse out your investments. You can put some of them in one area and some of them in another, and, pick and choose which should be in the tax sheltered vehicle versus the other. There is, however, also the point, which is that ultimately you just want the most money in your pocket. And so you might want to take an investment that is less tax sheltered because of the fact that it's just plain a better investment. And so I've had some conversations with people around this over the last while because of some of the investments that we've been doing that are, really solid, very high yielding. And some advisor might be like, oh yeah, but it's, not this. It's like, yeah, but it doesn't matter because you still end up with more money in your pocket at the end of the day. So that's the basis of this particular conversation. So what are the things that we need to consider? We need to consider a few things. Number one, we need to think quite a bit about the idea of the character of the income. And loosely speaking, we have essentially three types of character of income. So we have capital gains, we have dividends, we have interest. Now, yes, there can be rents, which are kind of interest-esque, okay, with some slight nuances. So we'll talk about those. And at the same time, there also are other considerations, such as things like liquidity, right? So liquidity can be really valuable. However, there are times when it's not really worth it, depending on what situation you're in. You could, of course, also have royalties and some things like that. Sometimes in certain places, things like gold or crypto are specifically taxed differently. You can see this nice steps here and this sort of thing. But ultimately, most of the time, they're going to fall into these few categories. And the thing that I want to emphasize for you here is that the assumptions that you have in one country are not necessarily true in another. So for example, in certain countries, in fact, a lot of the world, capital gains are taxed differently than non-capital gains. So for example, in Canada, it's typically half. In the US, it's typically half, etc. But then there's some other places where it's not taxed any better at all. And so what's the difference for you? It makes no difference, That's how it goes. The other side of it is that you have to consider withholding taxes. And so I've done some videos on withholding taxes in the past. We've talked a little bit about that. But this could really play a big deal in terms of tax treaties. I was talking to a client the other day, and he lives in a country that has less tax treaties than many of the ones that you might typically be interested in. And so he was interested in going into investments that paid high dividends. Well, guess what? If those are American stocks and you have no tax treaty, that's a 30% withholding rate. Sometimes that's worse than what you'd have domestically, depending on the tax bracket you're in and things like this. So all of these are things you need to keep in mind. So I'm going to give the sort of what I would call basic high-level guidelines. This being said, every situation is unique, of course, and so you need to tailor it to your particular case. And there are sometimes situations where you can use legal structures to build something around what you would normally experience. So you can sometimes use companies, you can sometimes use trusts, foundations, things like this to change the character of the income or change the tax treatment of the income regardless. And so those are the things that we help with here at Offshore Citizen. We deal with clients all over the world around this. So if you want help with that, you should reach out to us. As always, if you're not used to it, book a call with me at calendly.com/Michael-Rosmer. There's a link in the description below, or send a message through offshorecitizen.net. Okay, so what are the basic ideas? So generally speaking, if you are resident in a very low or zero tax country, most of the time you want to avoid dividend income. And the reason is dividends are very frequently subject to withholding. This isn't always true. If, for example, you had stocks in Singapore, you won't get dividend withholding on those. And so as a result, no big deal, fairly straightforward. But most of the time, a huge share of people's dividend paying stocks will be places like the US and other kind of comparable places where those dividends will be subject to a meaningful withholding. And as a result, it really hurts you. So generally not the best way to go. You're better off in those cases to have long-term growth. And you should be able to basically, if you want to get a dividend-esque experience, you just sell the asset in a small portion and you recoup essentially what is the dividend. Contrary to some people's belief, and I've done a video on this in the past as well, there's basically no free lunch. So it's not as though you suddenly are making more money because of dividends. What it does is it equals out some of the volatility a little, but overall, in general, at scale, it works out basically the same whether you're getting dividends or not. So that's something to be aware of. Not to say that dividends and consistent dividend payouts may not be an indicator of a healthy company. That's a whole other conversation. But just in terms of like the raw return, you're not getting free money because you have dividends. So be aware of that. Next, if you are in a situation where you are in a low or no tax country, usually there is an advantage to having liquidity that doesn't exist nearly as much in a high tax country. Why is this? Because generally speaking, when you sell, you're going to realize a capital gain, and that capital gain is going to be taxable. And so buying and selling in and out of things is not nearly as favorable in a country where you have higher taxes versus where you have lower taxes. So normally there's this like illiquidity premium. And that means that you basically get higher returns because something is illiquid. Well, that's probably worth capitalizing on in a high tax place. But it's not so worth taking advantage of in a place where there's no tax, because the ability to get in and out does have a certain value in and of itself. Now, yes, there are things you can do to work around that. So for example, you can be in a situation where you may like to go and borrow against it, right? Now, the reality is lots of things you can't borrow against. So that's its whole own problem. In fact, I'm working on a project right now to try and help to address that problem. So, typically real estate would be something you can borrow against, and any assets in a brokerage account. So stocks, stuff like that, but those are already liquid, right? And so liquidity and ability to borrow together sometimes go together because of the fact that those who are doing the lending are happier if they can liquidate the assets that they need to take over. So be aware of that point. Now, interest is a really interesting one because in certain countries, you do not pay tax on interest if you're not a resident there. So for example, in the US, I'll do some lending into the US. It's, I think, quite nice. You have a good legal system to protect you and things like this, and you can get fairly decent rates of return. And in those situations, what do you find? You find that there's something called the portfolio interest exemption. Again, you can reach out to us for help on any of these sorts of things, structuring depending on the country. And in that situation, if you qualify, you don't get taxed. Now, it's worth understanding there is a complex set of laws in the US to determine whether something is equity or interest, and it's not at all straightforward, so you can't just kind of structure it to call it interest, unfortunately. In fact, convertibility can be a problem there, but to the extent that it is actually going to qualify as interest, being able to take advantage of the portfolio interest exemption, very good, okay? The Another example would be Canada, right? So I do a bunch of hard money lending into places like Canada. We get some great deals there. And guess what? There is no withholding tax typically on interest in Canada, provided it's not to related parties. So long as you can kind of not have that issue, that's a big deal. And so I will actually favor, if I'm say going to go and do some sort of a real estate investment, rather than buying the real estate, which then is going to be exposed to the tax and et cetera, instead of doing that, to lend money in and take advantage of not having to pay the tax on the money coming out. So again, varies a little bit person to person. And also it's worth understanding that you may have tax treaties that will help to reduce this for you. So for example, US, the standard withholding tax rate on, say, dividends is 30%. That's with no tax treaty. But you can get as low as 5% in certain cases. And so 5%, might not be as big a concern. Although do be aware that, of course, dividends are after-tax dollars anyway. And so depending on where you are in the position, you might be able to benefit regardless, because if you could cut out the corporate tax, then hey, that's pretty good. So anyway, that's kind of a general overview, I think, in terms of liquidity, these assets, etc. If you guys have specific questions, please put them in the comments below. Something I don't really hear people talking about. Most people are not very familiar with the nuances of global tax and don't really understand, therefore, that what investments you should look for and how you can structure those will be radically different depending on where you are and your tax treatment. So happy to help you with that. Hit the subscribe button, hit the notification bell, check out the other videos, and I will see you on the next video.